For the first time in nearly 3 decades of data, these two lines are pulling away from each other. And the message is a serious one. Something inside the financial system is starting to give way. The blue line shows consumer confidence in the stock market, and right now, it sits near the highest levels of the past 3 decades. It's even above where it stood in the year 2000, a period remembered for extreme euphoria in financial markets. The white line measures how people see their own financial situation, and it comes from the University of Michigan surveys. Here, the picture is completely different. The indicator sits below where it was in the depths of the Great Financial Crisis, at levels last seen in 2022, at the tail end of the pandemic when inflation was peaking. So, on one hand, people believe the stock market can keep performing. But when they look at their own financial lives, they're almost as pessimistic as they'd be in the middle of a major crisis. This divergence is not normal. It's not just a statistical detail. It's the symptom of a deep-rooted problem. And for that problem to be resolved, the economy needs a reset. To understand where this tension comes from, we need to look at real personal income in the United States, the money people actually earn once we strip out the effect of inflation. From the late 1960s until 2008, real personal income grew at a fairly steady pace, roughly 2.8% per year. That trend gave people a reference point. They could picture what their income would look like 10, 15, or 20 years down the road. In short, people don't make decisions based only on what they earn today. They also act on what they believe they'll earn in the future. The problem is that after 2008, real personal income fell below its long-term trajectory and stayed there. Someone who, back in 1999, expected their income to follow the historical trend discovered 2 decades later that reality turned out far weaker. And here's the truly worrying part. The gap has started widening again. Draw the income trend from 2010 to 2020, and you'll see that since the pandemic, incomes have fallen behind for a second time. Someone who, in 2015, projected a certain income level for 2026 can now see that level was never reached. The stock market, meanwhile, has done the exact opposite. It has blown past expectations. Compare the growth of real personal income with the inflation-adjusted return of the S&P 500, and the difference is enormous. Since 2010, real personal income has grown by roughly 50%. Over the same period, the S&P 500 has climbed nearly 300%, even after adjusting for inflation. On one side, people have grown used to their real incomes disappointing them. On the other, financial assets have risen far beyond anyone's expectations. And that's where a structural divide opens up. But the financial economy can't run away from the real economy forever. Asset prices cannot drift indefinitely away from people's incomes. At some point, one of these two worlds has to adjust. That's where the idea of the Great Reset comes in. Some believe it arrives violently, through a brutal repricing of assets. Others think it comes quietly, with incomes slowly closing the gap. The real question is not whether this divergence matters. It does. The question is how it gets resolved and when the adjustment begins. Before we continue, a quick message. This is EconoBeats, a platform we're building. Inside MacroBeats, you track the economy in real time. You can see which market regime we're in and what you need to know about it. The phase of the business cycle matters just as much. A recession might be just around the corner. Plus, more sections that complete the macro picture. In reports, you'll find our research, equity valuations, and industry insights. We're launching soon. Leave a comment and you'll get a launch discount. Now, back to the reset. To understand the Great Reset, we start with the personal savings rate. Since the 1980s, it has been grinding steadily lower, from around 13% to just 5% today. Now watch what happens when we add corporate profit margins. While the average American saves less and less, corporate margins keep climbing. This divergence is the key to the whole story, because profits flow to shareholders, and shareholders, unlike wage earners, don't spend most of what they receive. They reinvest it into stocks, real estate, gold, private equity. That money never leaves the system, it just changes form, and the results are visible everywhere. Stocks, all-time highs. Home prices, all-time highs. Gold, all-time highs. All of it fueled by the same engine, record corporate profitability. And to be clear, none of this is a problem in itself. This is simply how the financial system works. The real trouble begins when this dynamic reaches the housing market. For decades, right up to the late 90s, the average American home cost about 4 times a household's yearly income. Since then, that ratio has climbed towards 7. In practical terms, that means housing has become almost twice as unaffordable. And this matters enormously, because shelter is the single largest component of the Consumer Price Index. When a growing share of income goes toward housing, there's less and less room left for saving, and, by extension, almost nothing left to invest in the assets that have been generating wealth for decades: stocks, gold, Bitcoin. In simple terms, many households stay stuck exactly where they are. Expenses keep rising, incomes don't keep pace, and the ability to build wealth through asset ownership keeps shrinking. All of this has pushed wealth inequality in America to its highest level since the late 1940s. This chart shows the share of wealth held by the richest 1% of Americans. This is the reset so many people are anticipating: inequality falling back toward the low levels of the 1960s, an era when the middle class was far stronger and wealth was distributed far more evenly. Now, if we overlay the S&P 500 on this chart, something remarkable appears. The 1929 peak in inequality lines up perfectly with the peak of the stock market. Back then, just like today, rising asset prices, stocks, housing, were feeding the divide. And the crash that followed, from 1929 into the 1940s, coincided with the start of a reversal in that trend. Inequality began to fall. But that shift didn't happen on its own. It needed a catalyst, a trigger powerful enough to force what we would now call the big economic reset. To find it, we replace the S&P 500 with the top marginal corporate income tax rate in the United States. In the 1910s, that rate was 0%. Then, over the following decades, policymakers gradually pushed it to nearly 40%. There are many theories about what truly caused the Great Depression, but this escalation in corporate taxation was, very likely, one of the forces that triggered it. It was painful. Profits were squeezed, asset prices sank, unemployment climbed. But it reversed an inequality trend that had been building for decades, and those high corporate taxes coincided with the longest stretch of low wealth inequality in American history. Then came the 1980s, and the pendulum swung back. Corporations were genuinely struggling, margins crushed, inflation high, growth weak. So policymakers cut taxes to take the pressure off business and restart the economy. And it worked spectacularly. Growth accelerated through the late 80s and 90s, and asset prices went on a historic run. Between 1982 and 1999, the S&P 500 delivered nearly 20% a year. But behind the scenes, those same policies were quietly setting the stage for inequality to turn and grind steadily higher over the next 4 decades. And today, the corporate tax rate sits at its lowest level since the 1930s, while wealth inequality sits at its highest level since the 1930s. Inequality has many causes, and no single chart explains them all. But this one almost certainly explains an important part of the story. Low corporate taxes have kept profit margins remarkably resilient, even with the American consumer under real pressure. Our view? The Great Reset begins the day this line reverses and starts moving higher. So what does this mean for the stock market today? First, we have to understand that markets price in the future. The market doesn't always wait for the event itself to happen. It's entirely possible for the market to peak before corporate taxes actually start to rise. That's exactly what happened in 1929. Stocks topped roughly 1 to 2 years before taxes were raised, starting in 1931. For now, though, the assets that benefit from today's macro regime keep attracting powerful flows of capital. Money keeps pouring into financial markets, and these assets are still supported by that very same mechanism. But at some point, the direction will change. And when the trend turns, the move can become fast and aggressive. That's when strategy has to shift from offense to defense. Before you go, one last thing. Turning points like this are exactly what EconoBeats indicators were built to anticipate. We're launching soon. Leave a comment below and you'll get a launch discount. Thanks for watching.